Okay, welcome to Managerial Accounting. We're going to start out here with Chapter 1. And remember that these presentations are just to get you warmed up to the chapter. We still have a full live class that we'll go over everything in detail on, but at least this will get some ideas for you on what we're going to be doing. Excuse me. Now this chapter has several learning objectives. It's got a lot of them, but you want to think about them in groups, okay? The first thing is about what managerial accounting is. And this is the differences between financial and managerial, because you just came from financial, so you need to understand how managerial is different, what management really does, types of information needed at different levels of the organization, and how they use it. Okay? So that's sort of one group. The next one is the types of data analytics that are used today. Okay? Every time you turn around, you're going to read something about it, and it's throughout our curriculum, so this won't be the last time you've seen it, and I know it's not the first. You want to be able to define the data analytics framework of a managerial accounting system. Okay, so this is a nice thought. Then be able to prepare a budget and analyze a performance report for a lawn care company. This is kind of a classic thing that managerial accounting does, is just analyze. It'll do what's called a performance report, and what we do is we look at the actual and the budget, and then we see what's different and what maybe our assumptions were different, or if something went wrong. Okay? Then we'll look at behavioral implications and talk about ethics a little bit. Okay? So this first one is important, this difference between external users of financial accounting. Okay, they get summarized, structured information from the income statement, balance sheet, and statement of cash flows. Okay, these are government regulators, shareholders, all kinds of external users that use that information, and they're compiled on public companies that have to adhere to generally accepted accounting principles. Okay, whereas managerial accounting information is internal users. So this is management. It might be management at a high or a low level, maybe with someone within a specific service or a product line. Could be about customers or suppliers, non-financial information. It's much more unstructured and broad, and it's got to be ready faster. This has external deadlines, okay, that seem fast at the time, but when I worked in managerial accounting, everything was due yesterday, and when computers came out, when they were born, then everybody wanted everything even faster. Now, the functions of management, and what you want to think about, these are actually three big categories. The first one is short-term and long-term planning. So short-term planning is what are we doing this year, and long-term planning is about where do we see ourselves in 5 years. Will we have more equipment, or another line of business, or are we moving into a different market? Okay, these are strategic objectives. And then we've got implementation and control within management. They come up with plans, they implement them, and then the control function is the report function that looks at analysis of how they did compared to plan. Okay, and then describing the decision-making required of management for both operational and strategic goals. We'll talk a little bit about some of the decisions that management is faced with to be able to complete and successfully, short-term and long-term management. And what do? They develop a strategic plan, they implement and control the plan, and they make decisions about the business. So what a management accountant does is provide information to all these three different areas. And a strategic plan is a long-term plan that what we base it on is having a vision of where we want to be, developing a strategy to achieve that vision, setting goals, all right, that give us like different periodic touch points where we want to be in order to achieve the vision again, and making and implementing a business plan. Okay, much of the information that we need is not in the financial statements, such as information about obtaining resources like materials, or if we need certain employees, decisions we've got to make about capacity or suppliers, or just the general infrastructure of the business. Okay? So implementation and control turns the business plan into action, and it continually monitors the plan. Okay, management continually monitors its plan. So mid-level managers have this responsibility, and they've also got the authority to take the steps necessary to achieve their goals. Decision-making is a function of all levels of management, and it requires managers to decide a course of action in the organization. Technological advances make it easy to capture more data than ever before, and companies can process the data quickly and easily. But the challenge is capturing the right data inputs, all right? Because if the more you have, the bigger mess it is and the harder it is to figure out what you really need. So data inputs, such as reports, graphs, summaries, and analysis, that's what they would include, and outputs need to be concise and easy to understand and help in the decision-making process. So the inputs is collected data, should be relevant and useful, and outputs, data processed to assist management in decision-making. Okay? All right. So the types of information needed at different levels, we want to be able to distinguish between the inputs and the outputs needed for management, and identify the types of information needed for both operations and strategic planning. So for operations management, when you think about the word operations is what we do every day. So operational needs include details like whether employees show up for work, if the equipment is functioning properly, if customers are satisfied. Operations management relies on reports that include specific cost information for materials, labor, and other production or direct service costs and selling and administrative costs. Okay, so operations management is, can go down to the lowest level of management. It needs current and frequent details to make tactical day-to-day decisions, and it relies on frequent reports that provide specific cost information. Okay, so it's really about operations, what we do on a day-to-day basis. But upper level management, they need to answer questions about their strategy. Okay, they're concerned with strategic decisions, and they need to answer questions about strategies related to something about what products maybe that we'll offer, our competitors, what the target market is. They need summarized reports about issues such as costs, profitability, innovation, market opportunities, and then tons of information about customers. Okay? So operations is operational, about what we do every day. Upper level management is really looking out. They're looking at more of a long-term basis and more of a broader view of the industry in general. We've got to identify three primary uses of managerial accounting information. Product costing is number one. All right, how do we know if we're going to make any money if we don't know if we're setting our prices correctly, if we're at the right place where we want to be in the market? So product costing includes everything it would take to manufacture a product. If we bought it from someone else, then that's a cost, like a Walmart. But for a manufacturer, it's going to include everything it takes to make a product. And we want to be able to explain how management accounting information assists management, and also we're going to look at some non-routine decisions. So the uses of the information, product costing, that's the cost of manufacturing a product or a service. Okay, and it's used for decisions about pricing and cost control. All right, and many times we look at both financial and non-financial information to evaluate a company's performance and make decisions. Qualitative information sometimes is more difficult to summarize, but sometimes there's better information in there than there is in the quantitative information. It's softer, So planning and control, this is financial data needed for budgeting. Okay, financial plans, that's what a budget is, and non-financial data needed to ensure the quality of products and services. All right, and then finally, non-routine decisions. Non-routine decisions are non-regular special strategic decisions. Like, do we start to work in Japan? Are we going to maybe export a product there? They need to be timely, relevant, and helpful data to help predict the outcome. We want to know whether or not it's going to succeed. And the data is found in management information systems. Okay, now the types of analytics used in today's environment, we're going to, right here, we'll look at 4 types of data analytics and how the different types of analytics can be applied in business to assist management with product costing, planning and control, and non-routine decision making. These 3 things right here that we just looked at. Okay, because that's what they use our information for. So the types of analytics, the first distinction you want to make is between structured data and unstructured data. Okay, raw data is unprocessed and not very useful. But with the right tools, it can be gathered, combined, and analyzed to get useful information. So structured data is uniform data that exists in a record, and it might be transactional data that has sales revenue. So we might have the date, a customer number, an item number and what was bought, how much was bought, a description of the product, and then the total amount paid, and maybe whether or not something's owed on it. Okay, that would be structured. And you collect the same data for each sale. Unstructured data is not standardized and doesn't really fit easily into a data model. Like text data, and a really good example is comments left on social media sites. All right, that's good. That's good information to have, but how do you analyze it and how do you summarize it? And then big data analysis is collecting and analyzing large amounts of digital data to assist in decision making. Okay, and we're talking really big. Okay, these are just massive piles of data. Now, different types of analytics. We're going to look at 3 types here. There's descriptive, diagnostic, predictive, and then we're going to go back to prescriptive again. Okay. So just to go on with it, yeah, descriptive is the simplest form, and it summarizes past trends. Generally, it's financial or non-financial information, and it doesn't really explain why something happened, only just what happened. Okay. Now we use an example in the text called the lawn care company, and for example, if that company changes its pricing, descriptive analytics can summarize its sales revenues by customer, by job, by service line, to determine which are the most profitable. Okay, so that's descriptive. Diagnostic answers why. So descriptive is what, okay? Diagnostic is why something happened. And many times if we compare it to historical data, that will help us figure out what happened. And it helps understand what's occurred in the past. Okay, so you want to know why something occurred. And predictive analytics is determine what's likely to happen in the future. All right, so we use what we know from descriptive and diagnostic analytics to make predictions. Excuse me, and techniques used include machine learning and statistical modeling. Okay, like that lawn care company might use predictive analytics to determine how much additional lawn cleanup revenue might be generated after a hurricane, combining current customer data, okay, with other types of information, okay, weather forecast, hurricane activity. And then finally, the most sophisticated one is prescriptive. This is prescriptive analytics. And this provides suggestions for future actions. Okay, like the following are used to analyze data, determine an action plan, and take corrective actions. We use advanced business rules and algorithms, statistical modeling, and machine learning. Now, a predictive analytics might be something like, let's say that we end up with a really big crisis on lawn care, and that we don't have water to water lawns anymore. Okay, so we might maybe get more into hardscape and provide a different type of product, say, for customers. Okay, that's all I could think of. All right. Okay, and now the framework of a managerial accounting system, how to identify the relevant inputs, how structured and unstructured data is processed, and how the information or the outputs can be analyzed to facilitate decision making. So a managerial accounting system captures many different types of data. It could capture sound, definitely financial data, information from a machine. It processes it, provides useful information that can be analyzed to to facilitate decision making. Okay, that's the output. And this is referred to as an input. Okay, that's the data. Process the data, and then the output framework. That's what we do. And here's another example of it. So we've got operational and financial data coming in, both as structured and unstructured data. It's processed and converted into an output that we can understand. And that's exactly what happens with financial statements. Okay? Or any visualizations that we might create from data that we have about use of certain machines or breakdowns or anything like that. And so what comes out is management accounting information. Okay? So this is a framework, and if you go back to like the lawn mowing service, what if you've set up your company and decided that for the first year of operations you're going to just focus on grass cutting? So to compete with the great big companies, you want to make sure you give personal attention to each of your customers and provide a quality service at the lowest possible cost. Okay, you also need to minimize your risk of failure by keeping your startup costs low. Okay, otherwise, you won't get over the hump. So you buy moderately priced equipment and a used truck rather than invest in newer, more expensive ones. That's just an example of it. Companies have strong internal and accounting and finance operations. Financial professionals understand the numbers. They need to understand the operational aspects of the business and the information needs of management. And management accountants also work often with others from different functional areas. Okay, you might not just even work in accounting. I used to work in financial control in a bank, but I directly reported to the information systems group. I worked for finance, which finance in a bank is really accounting. But I reported to ISG, they were called. Okay. So to gather the relevant data, a string of numbers, is not especially useful, but if the numbers are inputs to a system, they can be processed maybe as a phone number or a part number, or an inventory number. Then that string can provide useful information. All right, so the input would be unprocessed data items, like a string of numbers, including financial information, statistics, and other facts. And again, it can be quantitative or qualitative. Then the data is processed and it provides useful information. And we use both internal and external factors that affect decision making. So like for our company, an external factor might be economic conditions, competitors' prices for sure, our ability to find employees, the prices of materials. Okay, those are all important things that go into decision making. And we are almost done here. So for inputs, when developing a managerial accounting system, it's extremely important to make sure that the inputs collected will be beneficial to the company and ultimately to the decision makers. Okay, so a management accountant needs to critically evaluate the inputs and make sure that the following criteria are met. We want to make sure that the right questions are being asked, that relevant data is being captured, and that the data is being recorded correctly. Okay, so one of the things that we look at is maybe a target gross profit percentage that calculates the total revenue less total cost of doing business. That this is what we want to hit. But we've got a cost benefit constraint. Okay, especially when it comes to data, that the cost of getting additional data has to be less than the benefit. And the information gathering methods could include direct observation. It could be maybe interviewing customers or potential customers, and also storyboarding. So these are inputs for process. We use analytics programs like database programs like Access, okay, but really bigger ones. In bigger companies, you might use SQL a lot. Spreadsheet programs such as Excel. Sensitivity analysis shows how sensitive calculations can be to certain changes in key assumptions. Okay, so that's also called like a what-if analysis. I did that at work all the time. And then visualization tools such as Tableau and Power BI. Okay, and finally, the output could be financial statements, should be easy to understand and clear, should be correct, advanced visualizations, reports, dashboard stories. and management can use the output information to make well-informed operational and strategic decisions. Okay, so the report should be concise, be easily understandable, and timely. And data visualization software can be used to help management better understand and interpret it. Data visualization like Tableau. Okay, Tableau is a sequence of visualizations that convey the insight. Okay, that we gain by analyzing the information. Okay, one more part to this, but this is your introduction. I hope it wasn't too scattered. I don't know. It had a lot of pieces in here. The first piece here on the differences between financial and managerial. This is always important to understand. Functions of management. What the difference is between operations and strategy, and the importance of forming a strategic plan. Okay, and then the rest of it was really about information and the the input process output model, and the fact that we use qualitative and quantitative information. Okay, all kinds of data. Okay,